Welcome back to the Roll-Up High Roller community. As always, nothing on the roll-up is to be construed as financial advice. We are just some educators in the DeFi space. Toss us a quick like, give us a share, a repost, send it to a friend who may want to watch this, and finally, give us a sub or a follow. It means the world to help support credibly neutral educational content in DeFi. We're here to educate, empower, and enrich you, and let's jump in.
Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
What's going on, guys? Welcome back to the DeFi by Design podcast. Here today with Rob, as well as Nikhil and Tushar, the team behind Persistence and Dex Zone, bringing Cosmos to the forefront here today on the roll-up. Excited to talk more, learn about liquid staking. It's been a hot topic. Yesterday, we had a space with Nikhil and Tushar as well. We were talking about airdrops, so I'm sure we'll touch on that. But I'd like to dive into some of the technical stuff, the IBC stuff, and really try to bring our community on board. So, GM Rob, and welcome to Cosmos, brother.
GM, brother, feels good to be here. Tushar, maybe we'll kind of like start by like giving an overview of like kind of your perspective on Cosmos and why it has taken the forefront of modularity, and then we can get into kind of the architectural design choices and why you chose to build a liquid staking protocol.
Yeah, so I think before talking about Cosmos, I think it warrants a discussion on I guess my introduction and background as well, and I think that'll help answer the question about why we chose to build in Cosmos. So I think similar to you guys, I got into the industry during the 2017 mania. I am and was based in Singapore at the time, and Singapore was a great place to be as far as crypto was concerned in 2017. There were some big projects: Kyber Network, Icon, Silica, Republic Protocol. Those were some really large projects back in the day. I had the chance to be part of the journey of some of those projects. As an investor, did well enough on my portfolio to leave my management consulting day job. I was consulting for the private banking industry to get into crypto full time. Started a podcast called Decrypt Asia. The thought process was, in 2017, there were two seats of power in crypto. So Asia was a seat of power, especially China and Korea. And then you had Silicon Valley as a big seat of power. And Asian crypto and Western crypto looked very different. But they both had kind of self-sustaining ecosystems. So there were, fund managers, market makers, exchanges, cybersecurity service providers, and the like, both in Asia as well as, in the West. And my thought process was to bridge, Asian and Western crypto. High level, fast forward to 2024, I think the seat of power is, purely in Silicon Valley today. If you, look at some of the biggest projects that are coming out this year, whether that's, Eigenlayer, Celestia, Monad, Babylon, they all are being driven out from Silicon Valley. Of course, we're building from Asia with our teams, being based across Singapore and Dubai primarily. So high level speaking, after the podcast, I got an opportunity to be the first employee at the crypto arm of a traditional venture capital fund in Singapore called Golden Gate Ventures. In 2018, built out the fund in terms of working with, cybersecurity service providers, Monetary Authority of Singapore, lawyers, tax advisors to set up this dedicated fund, raise capital from a publicly listed company in Japan, multiple family offices in Southeast Asia and Western Europe, and also the VC arm of a sovereign wealth fund, deployed that capital, did fairly well, got in to a sub $100 entry into ETH, sub $5,000 entry into Bitcoin, sub $10 into BNB, and a whole bunch of investments that that did quite well, and we had a long-term view, so we let a lot of those investments ride for a very long time. But I wanted to be on the builder side as opposed to purely being a capital allocator. And so in late 2019, what we wanted to do was bring real-world assets on-chain, especially debt products, and to be even more precise, trade financing products. High level, through 2020, we realized that it's very difficult to bring real-world assets on-chain. People still talk about it, and it's good from a narrative perspective, but I think it's really difficult to bring real-world assets on-chain. You want to borrow against a real-world assets that is on-chain. How do you implement the liquidation of a loan, for example? It's very difficult to implement those things on-chain and connect that to the real world. So because we were trying to bring real-world assets on-chain is why we chose, Cosmos, and because of Cosmos's at-chain philosophy, where what you can do is you can customize things at the chain level to suit your needs. You can choose the number of validators that you would like to have. At that point, what we were also, because what we were trying to do was pitch our product to traditional financial institutions. They don't want an anonymous or a pseudonymous validator validating transactions and potentially getting to know about the transactions that they're doing. So in situations like that, what Cosmos allows you to do is figure out how many validators do you want, and do you want to know their identity. So, KYCing validators. And I do think that on a long enough time horizon, that is going to happen. With the ETFs and things like that, getting approved, and with the proof of stake market cap increasing, exponentially over the last 4 or 5 years, I do think that it wouldn't be outside the realm of possibility to have large entities like, BlackRock running validator nodes at some point. That was kind of our thought process with Cosmos. Basically, the ability to customize things. Of course, we didn't go down the real world asset path for a very long time, but in Q4 2020, we did a stake drop campaign, which I believe was one of the first stake drops to happen in Cosmos. We had created a very nice mechanism to do that stake drop, where stakers of Atom, Kava, and Luna, which were the 3 biggest Cosmos coins at that point, would receive a very targeted airdrop of the XPRT coin or the persistence coin. And within a 3-month, we had done this just as a way to distribute the token. It had not been done before in Cosmos. We were doing it as a marketing thing. But within 3 months, within 1 quarter of Q4 2020, we had in 2020 prices more than $1 billion worth of staked assets that were participating in the stake drop. So that kind of gave us an insight into the huge amount of demand that there is from the end users to drive additional returns from assets that are already staked. And I know Andy talks about that quite a bit, but that's basically what we see with TR today as well. And so that was kind of our high level, thesis, but also serendipity along the way, which kind of drove us deeper and deeper into Cosmos. Also, I would like to point out that in 2019, when we started to build, there were only 2 proof of stake blockchains that were on mainnet, and that was Tezos and Cosmos. So it was basically an evaluation of the technical due diligence done by our tech team in terms of choosing between Tezos and Cosmos. We bet on Cosmos, and of course, it's been a frustrating bet at times. Especially through 2021, where there were a lot of other projects and chains, Solana, Avalanche, Terra, that did phenomenally well. But I think Cosmos has a tendency to kind of gradually improve across all the metrics that matter, and that aligns very well with our philosophy of how we want to build and how we build at Persistence. So that's kind of our journey within Cosmos, why we chose to build in it, and kind of covering, I guess some of the, things that we've done.
For sure. So a lot to unpack there, but I just want to dive right into the kind of infrastructure of Cosmos. it's kind of interesting how Cosmos took this app chain route, scaled kind of horizontally, and is now trying to like bring them all together. And then for our listeners, obviously they're aware of like Ethereum scaling vertically with all these different rollups, and now trying to now going like more like these different app specific chain routes. And so these two designs have started off in different ways, but are now kind of trying to converge and solve the opposite problem or the opposite situation that the chain is in, or that the state of the network is in. I'm curious with regards to the network effects of Cosmos, kind of how you see the evolution of all these different app chains on Cosmos and the further growth of more, kind of what you see kind of bringing them together, and just generally with the kind of broader IBC connectivity, how the network effects of Cosmos and these app chains are playing out, what you see happening, kind of what is the vision to bring these together, to make things more interoperable, to make this ecosystem have a easier UX and a kind of a better experience overall.
Yeah, maybe I can jump in unless Tushar, you have some. Okay, yeah. So I think it's an interesting question. I've been talking about this idea of Cosmos and Ethereum converging to the same point for the last like couple of years. I could literally see that happening, and it's very beautiful to see it actually play out like that, because I think Cosmos was very ahead of its time, right? You see some of the things that have been done, like the thought process behind doing IBC. Like there were no bridges that were getting hacked in 2019, 2020. But the Cosmos white paper talked about IBC back in like 2017, 2018, right? So that's very unique to see. The reason for that was trustless bridging and trustless interaction between chains. Now, what was also very unique, and it's very easy to forget this part, is the fact that there were people who could see that there would be multiple blockchains who would talk to each other. Because if you look at Ethereum world back in the day, like, everybody cared about just one chain, and they thought there will be one chain and there will be thousands of applications on that one chain only. So Cosmos has been ahead of its time. The problem with Cosmos, like you rightly highlighted, is the fact that there's no network effects that have played out, for it yet, right? So with Ethereum, while the stack may not be the best, there's always opportunities for you to like correct the stack as long as there's users. But obviously the users are not going to stick around forever either. You have a window of opportunity until which you have to fix your shit. Otherwise, it's not going to work. I think obviously Ethereum will fix its shit. And it's not like it's in a very bad place with things like Celestia now offering, data availability and consensus. You just have to worry about, execution. I think it already solves a lot of problems. And one would say, Celestia is a Cosmos-based chain. It's solving a problem for rollups in the Ethereum. It's quite interesting to see that as well. But from my perspective, I think Cosmos has struggled a lot because there's multiple chains, and each chain is figuring out how to build an ecosystem for themselves, right? Like for us, Persistence is a chain that is looking to build an ecosystem for liquid staking tokens, but on the Persistence chain. Similarly, you have Osmosis. Osmosis started out as just a DEX. It had a few applications launch on its chain after that. But now they're vertically integrating and building all the applications themselves. And that's the beauty of like Cosmos, the Cosmos SDK, because it really allows you to control the entire stack. Now, I don't know if you guys saw this, but there was a recent announcement from the Skip protocol team about Slinky, which allows, like on chain, you have oracles built into the chain itself. You don't have to rely on, external oracle providers, which is crazy. Like you couldn't imagine something like this on any other chain, at least for now, or I cannot. There may be some technical people who could, so don't quote me on that. But based on the knowledge I have, it's almost like next to impossible to build something like that on any other chain for now. So Cosmos really allows you that customizability. And the problem with Cosmos, like I said, is every chain trying to build their own ecosystem. And then, there's no one economy that is being built out. With Ethereum, every rollup that does well kind of adds value to the Ethereum ecosystem, the asset as well, which is not the case in Cosmos. Although I think now we have this huge narrative about chain abstraction, chain aggregation, which is exactly what I think Cosmos
has been moving towards, which is you can utilize, you can talk to another blockchain from your blockchain without the user having to interact with the other blockchain. A very simple example of this would be interchain accounts on the Cosmos, in the Cosmos SDK IBC version 3, they released interchain accounts, which is essentially you can control an account on another chain from an account on this one chain. So from the persistence chain, if you have an interchain account that can control an account on the Cosmos Hub, you can, for the end user, it doesn't matter anymore, right? Where they interact or who they interact with. So these things, I think, will really make a difference, and we'll see a lot of super apps in the future where like one chain will just have all the applications, or if they do not have all the applications, they will rely on applications on another chain. But the end user only cares about interacting with this application on this one chain. So I think chain abstraction has been in the works for a very long time now within Cosmos. It's just not, I think Cosmos people are just not good at creating these fancy terms and marketing names for things that people build.
And to jump in, I think Mikhail talks about the long-term, his long-term thesis of kind of Ethereum and Cosmos converging, and also the super app concept. That's something I've been super bullish on as well, right? And now you see, of course, every cycle you have all sorts of players come in, right? Like it's probably your third bull market, it's third bull market, for me as well, and I've kind of stuck through now the ups and downs in the industry. My general thought process is that of course, even today, a lot of things are happening at the infrastructure level, but ultimately, things have to happen at the application level. And that's where things get very interesting, right? Where you have a lot of, B2C founders who are consumer and user oriented jump in, and kind of bring, a whole set of new folks, into the industry. And high level speaking, I think what will also happen, Mikhail talks about chain abstraction. I think going one step above, people who, abstract away complexities, for the user, what they will also be forced to do is comply with local regulations. So you'll have nice looking interfaces that have dedicated pages for certain geographies that matter, and certain geographies that are forward looking, such as Dubai, or UAE, such as Singapore. Of course, US will have its own framework, other geographies will come up with their frameworks now, but you have these satellite cities that are forward looking, where you would have dedicated applications, or dedicated DeFi applications in compliance with local rules and regulations and things like that. Of course, that may not happen, this year or next year. So we're kind of talking, 2-3 years away. But I do think that what's going to happen this year or within this cycle is, people not caring about which chain they're on, just having a really smooth interface and being able to, do away with all of the complexities of, operating on multiple chains and things like that. Otherwise, it's a mess, right? Like the alternative is that, like, liquidity fragments. The alternative is that users fragment. There's a lot of cannibalization, and it just dies a slow death. So I think that's kind of what it looks like. So there will be these kind of super apps of sorts that attract a lot of people. Of course, in the background, they rely on these base layer protocols that have built robust infrastructure. So that's kind of what we believe the future looks like. And of course, something that we want to work towards.
Yeah, exactly. That's the cool part. Everybody gets to build towards it. Yeah, a bunch of good points there. I think on the convergence thesis, it's quite interesting to understand from the perspective of kind of deep OG builders in IBC. It's not something that we hear all the time, but there's a whole nother conversation going on right now with regards to and this like modularity thing, infra, and you bring up a good point with kind of adapts. And I don't want to beat this one too hard, but it seems like each of the cycles we've had, some like the L1 infra bets, and it almost feels like it's time for some of these like consumer facing apps, but it's just so hard to actually build an app that is like consumer friendly with the state of infra right now. I'm curious what your personal vision is for persistence, as well as generally Cosmos when it comes to things like, account abstraction is what we call it in Ethereum land, different types of like things like email sign in and just onboarding friction and the reduction of that. I'm just curious how you see persistence tackling this, as well as broader Cosmos ecosystem.
Actually, at some level, I think we did have a little bit of that in the last cycle. It's just that everything blew up. So, you did have borrowing lending platforms like Celsius, like Vault. You did have, a whole bunch of other centralized players that actually, did abstract away the complexities of dealing with multiple blockchains. It's just that they, didn't do a very good job of managing their risk, including, having like an email sign on and things like that. So I think we, and this is a term that's been used in the past, stkDYDX. And I do think that, I don't know who will do that or build, in a nice way. And of course, we want to do that as well. So, we have, things in the pipeline and things in the works to actually make that happen and make it happen in a way where we're not trying to maximize usage of any particular chain, including persistence, right? So it just becomes like an end user facing application, which just sources the best yields, for the end users based on their risk appetites. Of course, that comes up, with a lot of complexity and things like that, right? Including on the regulatory side. So I think it's obviously, that battle is a UX battle and a regulatory battle. It no longer remains a technology battle. Whereas right now, a lot of the things are technology battles, right? So, I do think that at some level, that is the answer. And those applications in the 2021 cycle were the ones that had, massive usage and adoption and things like that. But we've seen the industry mature, and we're seeing, better and better actors come into the industry. We're seeing in 2020, if you wanted to build a team, you actually had to ask your friends to send in referrals or tap into your personal networks to build a team. Today, you actually have recruiters, to build teams. You actually have a whole bunch of suits enter the industry, which is, again, I think healthy for the industry as a whole. But again, I'm not sure if it answers your question, but from our
no, for sure.
Yeah. What we want to do is definitely abstract away the complexities, but our focus is the Cosmos ecosystem because that's what we know, right? And so I don't think we're going to say that, look, we're going to abstract away complexities, across the industry as a whole. But what we can do is abstract away complexities across Cosmos and be like, okay, if you want yields across Cosmos, app.persistence.1 is the place to come. Obviously, that's not live yet, but that is something that is in the works, where, app.persistence.1, we envision that as being sort of a one-stop shop to stake, to liquid stake, to LP, to put collateral and borrow, to lend, to put collateral, mint stable coins, and basically do a whole bunch of things that that takes place within DeFi. High level, we're very passionate about finance. We're very passionate about fixed income. within finance, and hence we work on liquid staking. We're very passionate about DeFi as a whole, and I think I mentioned it in the space yesterday as well. For me personally, it's a privilege to like build out an asset class, right? Like I'm not sure how many people can say that they were involved at the ground levels of the building out of an asset class. So I think that is quite interesting as well.
Yeah, I find it ironic how like stkDYDX broke, and like the C part of stkDYDX was the reason that it broke. Like there was plenty of like broken assets that were involved in DeFi, right? Like UST and the whole Terra Luna thing like that. There was a lot of DeFi applications that also had that, but it didn't break DeFi. It broke stkDYDX because it was inherently centralized. And now, and you mentioned like liquid staking is what you guys are really passionate about. It's what you guys are building out. Like there is a relatively significant like centralization risk of liquid staking happening over on Ethereum. It's called Lido. And like, there's some real risk there. So I'd really love to understand like kind of what your perspective is on Lido and the centralization risk it poses to Ethereum. And then like what your perspective is contributing to the liquid staking space on Cosmos. Is there like how have you been able to navigate that centralization, decentralization balance to make sure that you don't face the same risks that Lido and Ethereum are facing now?
I think I would just say it's an interesting question because it's also very controversial when a lot of people feel like, oh, this is not something we have to worry about. A lot of people feel it's something to be worried about. I have a very I find some sort of a middle ground between both those views where I believe, sure, there's risks for sure, 100%. I think the reality of the situation is slightly different though, because while Lido as a protocol may own a lot of these, may, be a very large contributor to blocks that are proposed on the Ethereum chain, I think there's a bunch of validators underneath, and those validators have some social standing, and it's not just limited to the Ethereum ecosystem. If you look at validators back in 2019, 2020, it was all within like two ecosystems, Cosmos and Tezos. That's it. That's where validators existed. Today, the same validators exist on every single ecosystem that you see, whether it's Solana, Cosmos, Ethereum. You go to any other ecosystem, it's the same validators everywhere. Now, if there is truly an event where, these validators collude to do something malicious, I think it just doesn't just affect Ethereum as a chain, it affects the entire industry, because where are people going to stake their tokens on any of these chains, right? So I think it's fairly, I would be fairly comfortable saying it's not going to really blow up. But I think the only way we see decentralization of stake is when it blows up. Until then, people are going to be okay with things, right? But the moment it blows up, that's when we realize, okay, now is the time to actually use different products. That's what we did with UST. There were so many people shouting, at the top of their lungs and yeah, it's a Ponzi. Nobody cared about it until UST blew up. And then nobody's touching algorithmic stable coins anymore. And you're probably not seeing them. So liquid staking generally has risks. And I think people have talked about it for the last 2-3 years now, so I don't need to go into those. But the fact that one liquid staking provider controls a lot of stake on a chain is definitely a big risk, but we have to be realistic about the probability of something malicious happening, which I don't believe is that high in this moment.
Yeah, but Cosmos is different, right? Because of the Cosmos SDK and Tendermint. We'd love to kind of understand that, and at a deeper level, kind of how the Tendermint validator network translates into liquid staking on persistence, and how you guys are able to keep that all kind of tight and neat.
Yeah, so from our perspective, obviously, maybe taking a step back as well, the biggest difference between Ethereum and Cosmos is the fact that people in Cosmos, they learned about staking before they learned about liquid staking, long before they learned about liquid staking. We actually were the first ones to introduce people to liquid staking in Cosmos back in 2021 with STK Atom as the first liquid staking solution in Cosmos. But in Ethereum, most people have only learned about liquid staking. They probably till date have no idea about native staking, right? And that's a design choice that's caused by a design choice that some ETH researchers made, right? Which was, we don't have delegated proof of stake. We'll have like every single validator, every single person who wants to stake, run a validator node with 32 ETH. That is what created this situation to begin with. That's my personal view. And I think now there are efforts to move in another direction on Ethereum. Within Cosmos, the most important thing is people are still like mostly favoring towards natively staking their assets over liquid staking. And there are various reasons for that, right? One is the airdrop season that we are seeing in Cosmos, where native stakers just get a lot of these airdrops. But there are certain very interesting mechanisms built into the Cosmos SDK now that would prevent a situation like what we see on Lido, for example. So, or on Ethereum precisely. One such example is the liquidity stake module. So, liquidity staking module, so called the LSM, which is built by Inclusion, Zaki's team, and we played a big part in taking that live as well. So we supported the testing and putting that. In fact, that module went live on the persistence chain before it went live on the Cosmos Hub. So what that module allows you to do as a staker is, if Andy, you have some atoms that you've staked with a validator today, if you want to liquid stake those assets, you will have to, before the existence of this liquidity staking module, you would have to unstake your atoms, wait for 21 days, and then stake it with another validator, or liquid stake it. Now, after the LSM came out, Rob, if, for example, you were already staking your atoms, you don't have to unstake them to move it to another validator node. Like, you can immediately do it by just, tokenizing your share. With every delegation you make, you get a tokenized share now. And you can just transfer that tokenized share into another wallet, or you could just, lock it on another validator, use a liquid staking protocol that accepts these shares. Now, with a situation where there is maybe a situation where you feel like, okay, one liquid staking provider is too big now, all of a sudden, within hours and days, you could have people just convert their, staked assets or swap them out, or natively staked assets, they could be converted into LSM shares of any other protocol, right? So there are methods to how you could mitigate risks. And the most important thing, I think, for us is making sure we delegate to, like, as a liquid staking provider, the job for us is not to gatekeep validator delegations. I think that's where, like, Lido decided to create their own set, for example, and it worked out for them for various reasons, mostly the network effect reasons and the fact that they were early to the game. But as a liquid staking provider, your job is in a very big way to ensure you don't create unnecessary risks for the host chain or the chain that you're building liquid staking for. And at the same time, you're doing right by, like, you're not gatekeeping delegations. You're not saying, oh, you're a bad validator, you're a good validator. No, you're the best validator. What you do is you stick to facts. So that's what we do at Persistence. With the pstake module that we've built, the job for us is to make sure we look at all the on-chain parameters that exist. If there are, like, parameters like, okay, what's the uptime of a validator? Was this validator ever slashed in the last 6 months? Has this validator, how much commission does it have? This validator has, like, can this validator change its commission from 10% to 100% in a day? We look at all those things, and it's all transparent on chain. And that, based on those parameters, there are various scores that are generated for each validator. And, top X validators right now on Osmosis, for example, we select about 75 validators. DYDX, we're launching liquid staking for next week. And that will have about, I think, 30 validators that will be selected. So this parameter transparency-based model allows you to keep rotating delegations. Also, we have this automated rebalancing model where on a daily basis, these scores are again calculated. And if a validator is not performing to the best, these delegations move from one validator to another. So it's always about selecting honest validators at every given point. In Ethereum, you can't do that. Like, stake doesn't change hand. You have new delegations that come in and new validators that are onboarded that receive these delegations, but not rebalance delegations, right? Rebalancing, you could also call that rebalancing the Ethereum, but that takes a much longer time than what you see in Cosmos. So yeah, Cosmos has some interesting, functionality, especially because of the DPoS nature of the chain.
Now, by the time this goes live, stkDYDX will be online. So with that understanding, I'd love to, like, understand a little bit more. And I love your answer because, like, Lido has all of its stake and it's all in Ethereum, where you guys are more like an aggregator for like a bunch of different chains that are on Cosmos. So it's less likely that you develop a centralization, like a stake that is so significant that it poses a centralization risk, because your stake in P stake is made up of several chains. It's not all committing to one chain. So that being said, like you also mentioned that it's almost like this like validator aggregator network where P stake has like its conglomeration of deposits that go into it, and then kind of like make the decision about what validators it is then going to delegate its stake to. So I'm curious, like when you're looking at a new application or a new app chain in the Cosmos sense, like DYDX, right? What are the decisions that go into integrating stkDYDX? Like, how do you analyze their validator set and then ultimately like choose, okay, we're going to integrate DYDX and we're going to integrate these specific validators of DYDX?
Yeah, that's a very good question actually. So, maybe to answer the specific question about DYDX, right? Let's say DYDX is probably one of the most exciting applications you see in Cosmos today. It is one of the only applications I would say that has real traction and adoption. Obviously, there's other platforms in Cosmos like Osmosis that has done really well. You have a lot of up and coming chains. You have Neutron. Persistence has been around for a while. You have some good chains now. You have Celestia that has recently launched. I'm sure there'll be like so many more app chains that come about. For us, the decision when it comes to, first of all, selecting which chain to support or build liquid staking for, Tushar talks about this very well. I may not do justice to this, but it talks about building this portfolio of sorts where you have like similar to how you, if you're an investor, how you build a portfolio where you choose which token you want in your portfolio, right? Based on certain things that you want to bet on that coin. You want to know that. Tushar, I don't know if you want to jump in, but it's basically where, like, okay, this token is going to do well, this product is going to do well. So you want to, support that or bet on that. Similarly, with liquid staking, P-stake, any token that it supports, whatever revenue P-stake generates is denominated in that token. And that's how P-stake's revenue grows. Now, when we select a chain like DYDX, it's so obvious that you want to bet on a chain that has, product market fit to begin with. And the most important thing that you look at, like DYDX is a very good example. Why? Because there's like 80-90 million tokens that have been staked out of 1 billion tokens. So that's like less than 10% of all the token supply being staked today, which creates a very interesting, dynamic. Why? Because first of all, a lot of people are still not staked. Now we have to understand why they may not have staked. I think the most important one is the fact that DYDX was an ERC20 token that was migrated from the Ethereum chain to their own DYDX chain. And a lot of people may not have done that yet. But when they do it, they won't know how to delegate because they have never been a part of a DPoS system. All they've learned is like, oh, I deposit into a liquid staking protocol and that's it. Now that's something that excites us, or that makes a big difference. If you look at DYDX, the chain, there's like 2 validators at the top. Actually, the first 3 validators control 45% of the voting power of the chain, which is crazy. Like you won't see that anywhere in Cosmos, I think, at least at this stage. But DYDX is still a very, largely new chain, so it makes sense. But with P-stake, what we can actually do is distribute that stake to a lot more validators and reduce the risk that are associated with these top 3, top 4 validators. So for us, it's about selecting validators who may not be centralizing the network more, but rather decentralizing it more and more. And like I said, our job is not to select the right validators. We just say which are probably the validators who don't meet the criteria that you need to be a really world-class validator. And only those would be like not in the set. DYDX has, I think, 60 validators. Out of that, 30 are going to be selected. By the time this video is out, you'll see 30 validators getting delegations, which is 50% of the network. And that is going to be based on certain parameters like I mentioned.
Why don't you guys run your own validators? Like maybe this answer lies in the fact, like the difference between proof of stake and delegated proof of stake. So it would be great to kind of like get like a comprehensive understanding of what the difference is. And then, yeah, I'd love to understand like why you guys don't run your own validators.
We do. The answer is we do. We run validators under the moniker or under the brand audit.one. But again, I think what happens is that, it's at some level, it's a conflict of interest as well, right? Like we don't, like what Nikhil said, we don't want the underlying chain to be centralized, or centralized because of us. We can, of course, from a business perspective, it would make a lot of sense. Or from a commercial perspective, it would make a lot of sense. We can say, okay, anyone that liquid stakes via P-stake, why should we delegate to any other validator but our own validator, right? We can, of course, say that. That would obviously help us make more money, but that's fundamentally net negative for the protocol that we're building liquid staking for. And the community is going to be against us. So at some point, they're going to stop liquid staking with us, because the liquid staking business and the staking business, to some extent, is at odds with each other. So, of course, why do we run validator nodes? It helps us understand newer networks. Right? So if we start validating as a validator, building capabilities on the technical side, on the liquid staking side becomes easier. So it's a way for us to train our team. It's a way for us to understand networks. It's a way for us to enter the community of different networks. So there are networks where we may not do liquid staking for, but we definitely run validator nodes. Actually, at the peak of 2021, we had about $600 million in total delegations on our validator. We just chose to not push on the, I think 100 plus million out of that was on Terra. But we just chose not to push, too heavily on the validator business. But that's something that actually we are reconsidering. So high level, if you think about it, we've vertically integrated. So we run validator nodes. We have a proof of stake chain. We do liquid staking. We build liquidity for liquid staked assets. So it's essentially a vertical integration of staking plus liquid staking. And that's, I think, one of the differences between us and other liquid staking providers, right? That we provide that full stack. Again, like I said, ultimately for us, like we're commercial, people. We want to run profitable businesses, and from that perspective, for us, what we believe is that Audit One as a validator, the chain itself, P-stake, Dexter, can all get to a point where they're doing like $1 million, $2 million, $3 million in revenue annually. At which point they become self-sustaining, right? Because you need small teams to run these businesses. And so that's kind of, our high level, thought process. And again, I think it goes back to the initial thing that I mentioned about our overall thesis of loving fixed income, of loving cash flows. Of course, over a period of time, we'll figure out how to, do right by the community and those kinds of things, and where those cash flows should go. Should that go to the protocol so that the protocol can make decisions about what to do with that cash flow? Should that be distributed back to the community? And what is the best way to do that? What is the most compliant way to do that? And so those are things that we're kind of figuring out. But we do run validator nodes, and we used to do that a lot more seriously. Right now, I would say not that seriously, but we still kind of do it to understand networks.
Andy may have another perspective to add here, but I'm still curious about like one thing that you mentioned, which is that like the staking industry and the liquid staking industry are at odds with each other. To me, like, and this is just me thinking through it in real time, those would be like very friendly, because if I have a lot of stake, I want liquidity. I'm going to want to liquid stake that and then use all of my stake, not like unlock all of the stake that I have in validators and use it in DeFi and use it so that it's liquid. So why are these two industries inherently at odds with each other?
I think it depends on which ecosystem you look at, right? Within Ethereum, it's actually, I think liquid staking and validator businesses are actually, they go hand in hand. Because as a validator, there's not enough demand for native staking. But within Cosmos, there's more demand for native staking today than liquid staking. The moment liquid staking starts to do well, validators start losing certain dedications, because people who are liquid staking are actually stakers to begin with. They are staking with a validator for years now. And when, like, if I had, a million atoms, I wish I had a million atoms, but if I had a million atoms delegated to Andy's validator node, and I decide to liquid stake it with pstake, that 1 million atom is going to get delegated to like 65, 70 validators on the Cosmos hub. So I'm essentially cutting off, Andy's, cash flow by a big margin, right? But as more and more people start staking who are not staking, as more and more people start liquid staking who are in staking, Andy starts seeing the benefit of liquid staking now. But until that happens, and in Cosmos, we haven't reached that point yet. So in reality, like within Cosmos, those businesses are at odds with each other.
Yeah. So again, it's, also ecosystem specific. I think people in Cosmos are a little bit more sensitive as well, right? So, suddenly Audit One becomes a big validator and, we're a liquid staking provider. I think people will have problems with that. Or potentially may have, problems with that. So, we actively, but in Ethereum, it may not be an issue. So I think it also depends on what you want, or what is your core business, is your core business staking, or is your core business liquid staking? And if you want to push the narrative of being decentralized or leading the underlying chain to be decentralized, then you can't take the same stance as I want to be a validator and I want as much stake as possible to my validator node, which actually leads to centralization. So, of course, there's some middle ground there. So yeah, but I wouldn't say it's completely at odds, but to some extent. And if you're a validator but not a liquid staking service provider, it's fine. But when you're both, that becomes somewhat of a small issue. It's not a big issue.
Yeah. This is fascinating because it dates back all the way to Bitcoin. And we were talking briefly about Bitcoin before we hit record. And like mining pools and cloud mining were like a pretty big thing in Bitcoin. And it was always like there was some different trust principles that you had to factor in, because you were essentially trusting this like cloud server that was like running its own mining pool. And you were just kind of like putting your Bitcoin at stake in this mining pool. And you had to trust them. And then you also had to consider like the monopolization, like the monopoly risk, right? Because if it's profitable and I can only, and I only have, let's say I only have a little bit of Bitcoin and I want to earn some mining rewards, then I could contribute like my little bit of Bitcoin to this mining pool. And then let's say the entire mining pool hits a block reward, right? It's more likely to hit that if it has a lot of Bitcoin delegated to it, then the block reward is split amongst all of the people who are contributing to this mining pool. So it makes sense to like for everyone to go contribute to this mining pool, because like they have a better chance of earning more Bitcoin. But as you guys are saying, it's a very slippery slope, because it leads to monopolization and large pools of Bitcoin, or generally stake, concentrated into a very small area. And that centralization risk poses like a real threat to the decentralization of the network. So the evolution of this concept has taken many twists and turns, but I think we're still like very early when it comes to liquid staking and considering the centralization risks of pooling together funds.
Yeah, I mean, and I guess, since you brought up Bitcoin mining, I think if you talked about Lido and, how Lido has, led to centralization within Ethereum. I think people forget that, like, for the longest time, and I actually haven't followed this now, but, there was a time where Bitmain and F2 Pool and a couple of other people who all the way, like, by the way, were all friends and like all lived near each other, could just collude, right? I mean, it was like two mining firms,
and they had like
joining hands.
Over 50% of the Bitcoin network.
Exactly. So Bitmain and F2 Pool combined had more than 50%, right? So you could have, but so you had two miners just contributing. But again, I think, and that's the thing, right? Like once you have a network big enough, there's there's consensus on chain, there's social consensus as well. And I think, there are certain things that do get implemented, socially. Of course, you can never trust that fully, as much as you would, trust, consensus on chain. The other, conversation or debate is centralization versus decentralization, right? Like, is 50 validators decentralized enough? 100, 500, 1,000, beyond the point, it's just wasteful. It's like, you're wasting resources. I don't like what the answer is on that spectrum. Is it 2 or 20? Is it, 20 or 200, or is it 200 or 2,000? It's an open debate, and we'll kind of, figure out. But that's what I also think is the beauty of crypto, right? You can run these experiments very quickly, see what the end result would be very rapidly. Of course, sometimes to the detriment of the people, starting those companies, or, starting those projects. But high level, I think the debate between centralization versus decentralization, the world always, follows power laws, right? The whole 80-20, value, 80% of value accruing to 20% of the stakeholders. So I think we see that in crypto as well across the board, even with validators. We're going to see that with liquid staking providers. We're going to see that, with miners. We see that with centralized exchanges. We see that, play out everywhere. We see that with fund managers. We see that with podcast listeners or audiences. And that's just the, the rules of, of the universe. But of course, if we, again, on a philosophical level, if we talk, you guys have this show, if you were in the 70s, 80s, you would have to, convince some, dude in a suit to let you have a radio show, right? But now you can be sitting in, Puerto Rico and Thailand, for example, and, us, sitting in Singapore, Dubai, doing this, show, which, thousands of people or hundreds of people might, tune into. So is that marginally better than what the systems were before? Yes. The experiments that we're running in crypto, do they lead to marginally better results? And can the quote unquote real world learn from these lessons? 100%, right? And I think that's where the real world, quote unquote, should pay attention to some of these social experiments, economic experiments, sociological experiments, concepts around game theory. People should study these things from crypto, because I feel it's like a $1.5 trillion experiment, which in the grander scheme of the world is very small. But you get very valuable lessons about how, incentivization works, disincentivization works, how a whole lot of other things, right? Which is why, again, I choose to work in crypto, because there's just so many aspects to think about and learn about. It's very intellectually, stimulating and challenging.
Yeah, I tend to agree with you. Like my perspective on the decentralization convo is like basically like it's more about distribution of stake, where like as long as you don't have over like maybe one, if it's 100 validators, there's not a whole much of an advantage of having 1,000 validators over 100, as long as like that stake isn't concentrated in 1 or 2 people. Like you just want to make sure that there's not like maybe over 1% or 2% stake in any one given party in that sphere. And yeah, like I do think that the experiments that we're taking now are creating better systems, and like modularity was inevitable. Like if you look at TD Bank and you look at like all the banking industries, like they're all inherently monolithic. All of those things are concentrated into like one stack. Now there's opportunities to blow those out and get involved at each part of the stack. So yeah, I tend to agree that these experiments that we're doing on distributed systems as well as modular systems are incrementally better and will continue to get better with time.
Yeah, agreed.
For sure. So when staked
I think we'll wait for Celestia to launch interchain accounts.
Yeah,
we talked about chain abstraction. I don't want to do something that's the exact opposite of that.
Fair enough. Yeah, it's a good idea. How can our community get involved as we kind of wrap up here? Where can we get some good yields on chain, and what are some opportunities that our community can take advantage of?
Yeah, I think there's enough happening in the persistence ecosystem as of today. We have a liquid staked Atom, we have liquid staked Osmo, we have liquid staked DYDX going live, and by the time this episode is out, will be live. We start off by building liquidity for these liquid stake tokens on Dexter. So app.dexter.zone is where you can provide liquidity for these assets, and obviously there are incentives towards these pools which are variable and keep moving. So I can't point to a number at this stage because by the time this goes out, it might be something very different. So yeah, you could look into Dexter and obviously STK Atom, STK DYDX, STK Osmo. These assets will be available on other Cosmos-based chains as well, where you could use them as collateral. Like, you could use STK Atom as collateral on Mars to loop to play a looping strategy where you generate more staking rewards than you would if you just held Atom staked Atom vanilla positions. If you want to do something more exciting, you could use STK Atom as collateral on Inter protocol to mint IST. There's a proposal ongoing for using STK Atom as collateral to mint USK on Kujira. There's STK Atom is available as a collateral asset on Umi. All these integrations will also be available for all the other STK assets that go live on the persistence chain. So yeah, exciting times ahead. Lots of these integrations happening.
I think Nikhil is building the case for app.persistence.1 as we speak.
Yeah,
because
It's already built.
because I will also get confused where to farm that yield with
yeah. All the ones
just named. It has to be. I don't think there is any other way.
Super app. Well, thank you guys for coming on and shedding some insights about Cosmos, liquid staking, validating, and intermint, SDK. All this stuff is much appreciated, and we appreciate your time.
Thank you, Andy.
Thank you, Andy.
For a
Thank you, Romney.
conversation. Take care.